All right, everyone. Welcome back to this week's session of Banks Wants You to Know, your latest source for financial discipline and literacy. Hope you all have had a fabulous and happy Easter, happy Resurrection Sunday. And since today is a holiday worth celebrating, I'll try to keep this session, short and sweet. But there's just one that passed that I'm sure we are very reluctant to celebrate, and that was Tax Day on April the 15th. And as you all know, there are two things that are guaranteed in life: the end of life, unfortunately, and taxes. Oh, those lovely taxes we all want to pay every year. Yeah, right. I'm sure we'd be elated to be done with paying them all, but I'm also sure we would still want some type of tax refund, some type of big deposit if we qualify for them, right? I know I would. There's nothing wrong with a little extra cash as long as it's used correctly. But for those unlucky ones who had that balance due instead of that amount refunded, I feel your pain deeply. So my wife and I, we were a part of that unlucky crew. And being part of that unlucky crew has actually been the case for us for the past few years after several years before that of enjoying that boost to my savings in the form of a tax refund. But in past years, we were kind of unsure of why we were owing the government when it seemed like we had our documents correct with our respective jobs. Then I was starting to think maybe I was doing something wrong. So I have some experience as a tax preparer at my previous job. So I was keying our own taxes for a few years. Then I started using online software programs such as TurboTax. So this year we decided to go face to face and see a tax preparer, Jackson Hewitt to be exact, for the first time, and they got us straight. So really, shout out to them. But what we found out from the rep who was helping us was alarming. But it was also a relief to us because now we know what needs to be done to be ready for the next tax year. And that's going to be the goal for me in this video to lead you to that point as well. So we all can be ready for the next tax year. But basically, not enough federal tax was taken from our paychecks. It had me thinking, so what's the point of filling out all that tax paperwork, all those tax forms that you have to fill out in the beginning of your new job, if the government still feels like what they're taking is not enough? Needless to say, we had a lot to pay back this year. I mean, a lot. But we had a couple of things to adjust. So today, I'm going to pass on some things I learned in order to help you all to, prepare for next year, hopefully not pay or even just break even. So whether you owed as little as $5 or as much as 5,000 or even more, um, when April 15th came, this video is for you. So let's jump into this thing. All right, now before I go any deeper, I just wanted to introduce to you all how tax is calculated, just in case you were interested. So yeah, it can be simple math, even though uh, with me being a tax preparer before, it's not as easy, but it really is addition and subtraction. So um, whatever. So for this first one, to get a refund, whatever the government says is expected to be paid by you according to your income, if that's less than what was taken out of your check to be paid, that's how you wind up with a refund. The reverse of that, if your expected tax amount happens to be greater than what you actually paid, then that's when you have an amount owed owed back to them to, I guess, meet that requirement. And we'll talk a little bit more about that later on. And then speaking of, if you did have an amount owed and you didn't make that payment by April 15th, which I hope we all did, then some people may have experience with this. Then you can have a payment plan for the next 6 months going into October, but that's with interest. And then if it's not paid by October 15th, I believe, then more interest and more penalties start to accrue. So hopefully we can all avoid that. And with these tips that I'll talk about today, hopefully we can avoid that in the future as well. All right, then first tip I have here is withholding about 10 to 12% of your gross pay to be withheld for federal tax. Our tax preparer even mentioned as high as 15%, but only if you're comfortable with doing that. But that good benchmark is really 10 to 12 to ensure that your employer is withholding as much as possible to satisfy the government. So for example, let's say gross income for the month of April, $5,500. Uh, to get to 10%, you're really just carrying the decimal. It means you would ensure that at least 550 would be taken for federal tax. And then also, you may even have to set a certain amount of funds for additional tax to be withheld. So, for example, one of the adjustments that I had to make was adding an extra 100 a month to go towards that federal tax, just in case that 10 to 12% happens to not be enough. I wanted to throw a little bit extra just to make sure that whatever the government wants, I'm gonna go ahead and give it to them on the front end, so that when the beginning of next year rolls around, I'll be able to, um, we will be able to get a refund on the back end. And then this method, of course, will require some type of sacrifice and some discipline. That sacrifices, okay, I won't have as much money coming from my paycheck. I'll see a little bit less, but at least I got something to look forward to at the end of the year. Well, really into the beginning of next year, in the form of a bigger tax refund. Or if you've been paying for the past couple of years, you haven't seen a tax refund. That'll be a pleasant surprise for you to get that tax refund. Be able to allocate it to your savings account, to a vacation fund, to any type of fund, any type of thing that you aspire to do. So that's good news. I like to share with you all, and hope you all can get on board with that. Now, the next thing I'm going to mention to you, it took me a while to really understand this. So hopefully, I'm able to convey it in a way that you all can understand as well. But one major thing that I learned with our meeting at Jackson Hewitt about our personal taxes is this: if you put a number down on your pre-employment paperwork, uh, maybe from that last tax year that you see that you have for deductions, whether that's the standard deduction or itemized deduction, whichever one was the uh, the greater amount. If you put that number down in your paperwork, then your employer, they may take that amount and they may say something like, well, this person, since they're getting a lot of they're making a lot of donations and they have a lot of other forms and things that qualify for these deductions, they may be able to make up for the lack of withheld funds for their taxes with these deductions. So we won't take as much funds out for federal tax. So that means you'll get greater amount in your net pay. Not as much will go to your federal taxes, but in the end, if those deductions aren't a big large amount, then you'll still have a balance to owe. And those donations can include like cash donations to like your favorite charities, to church through tithes and offering, or even other deductions like what you paid towards your student loan interest, mortgage interest, or vehicle registration tax, property tax, and definitely some others. All right, so an example I have here, just made a little quick example. Let's say, all right, you got a tax balance due of $1,000 after you put in your W-2, uh, other account interest, things like that. You put that in. You do $1,000. So then, but you have a statement that you've given to the church. You've given $500 over the past year. You paid 250 with your vehicle registration. You also paid 250 with student loan interest. Um, then they're able to balance out. This is 500. That adds up to 500. They're able to balance out. You break even, and now you don't have a tax amount that's due due any longer. Now, if you happen to not pay any student loan interest, maybe you say, okay, my payments are too high. I've, I'm in forbearance. I'm in default. Whatever the case may be, you didn't pay anything towards interest. Then that would add up to 750. You'll still have a tax balance that's due of around 250. So those other things that you do during tax time or really throughout the year really helps you during tax time. So whether it's charitable donations, interest statements, things like that, whatever you can contribute that you say you paid that qualifies, that will that will bring that down as much as possible. Not sure if I've mentioned this already, but as your pay goes up, your employer may not adjust the withholding with your salary, and that could likely be due to these things called tax brackets, which are levels of income ranges that determines how much one pays in taxes per year. So let's say you get a nice raise on your job, or you get a promotion, or maybe you switch jobs and you get a major increase in your salary. Yeah, that means more money and all the things that come with it, but that also means more tax to pay. So, hey, the more you make, then the more they take. That's also called the progressive tax or the progressive graduated rate system. And I'll have a link about a video that better explains that in the description. Now, one thing to note is that all of your income does not get taxed at that one rate that your income figure falls into. All right, so for example, let's say my wife and I we're on target to make $150,000 between the two of us this year. Hypothetical situation. Let's say we're able to make $150,000 according to the graph. That will put us in the 22% tax bracket. Well, moved on from 10%, moved on from 12%. Now we're in 22%. Now the limit to get to 10% would be 23,850. So this amount will get taxed at 10%. Then you move on to the next bracket. The limit for 12% would be 96,000 96,950, which if you subtract this from that amount, then you get 73,100 to make it to that 96,950. Then I'm on to the next one, and the difference between 150,000 and that 96,950 would be $53,050. So it's not saying that with the 22%, all of the 150,000 is going to be taxed at 22%, which is why in tip one, it's still applicable to pull that 10 to 12%, or maybe even that 15% to help meet those tax goals, so you won't pay next year or in future years, because there's still some portions that will be taxed at 10% or will be taxed at 12%. But the point that I'm trying to make here is check your tax information yearly after you have filed for the previous tax year. Make those adjustments that you need to make um, so you can be better prepared for that next year. Because as you're making money, your employer may not be able to adjust the withholdings. Then before you know it, you're paying, and you really don't know why. So just like I've said in other videos about checking, your bank statements, your account activity, the funds you have. This is a key thing to also check as well. Yeah, just don't be like me and wait a couple of more years and then figure out, oh, I finally need to do something. Don't be like me in that aspect, I would say. But a major part of being financially disciplined and being financially successful is to pay who and what you owe at the appropriate time or by their due date. We experience this more with our bills and with our obligations. This goes for people that have loaned money to us. We want to make sure that they are paid back in respectful time and in a respectful manner as well. Being in extended debt to anyone or anything, any company, will not get us out of that financial bondage that we seek to exit from in our lives. If you've unfortunately had to pay taxes this year, make your best effort to pay them to eliminate bigger problems down the stretch, such as added interest or liens placed on your assets or properties, garnishments from your checks, just all that crazy legal stuff that we want to avoid. Also, I say also be thankful, especially if you were able to have the funds to pay what you owed by that deadline. That means that God has provided for you and has been working on your behalf to cure something that might have been, well, likely has been stressful to you. And that brings me to the verse of the session, which comes from Romans 13:7. Give to everyone what you owe them. If you owe taxes, pay taxes. If revenue, then revenue. If respect, then respect. If honor, then honor. Now, for context, the verses that came before this one, verses 1 through 6, really talks about us submitting to or abiding to authorities and laws in our lives, and really just the rewards and the consequences of our actions towards them. And paying taxes is part of abiding by a law set for all citizens in this country, and there are steep consequences if they are not paid. Now, I bet you didn't think there would be something about taxes in the Bible, huh? Hey, there's something in the book that can speak to every situation. But when it comes to paying these taxes in large amounts, worry not, because God will provide for us while giving us a better plan to follow for a better outcome, hopefully in the form of a refund in the next year. Now, I would like to thank you all for tuning in to this session of Banks Wants You to Know, where financial discipline equals financial success. I really appreciate you hanging out with me on this Resurrection Sunday, learn about some things about finance. If you've heard something that you find useful for your financial journey, then great. Please like the video, subscribe to the channel, and share this with someone who can benefit from the content. Times are hard, but we can build financial success together. And also, drop down in the comments. Let me know how you handled tax day situations in the past, or even this year, and just how you really feel about taxes in general. Thank you again. Class is dismissed.